Hi and welcome to our video on You've bought an investment property, now what? How to build a property portfolio. Presented to today, you're probably aware, Catherine Smith, number of degrees and diplomas, but more importantly a passionate property investor for over 20 years, so I walk my talk. Disclaimer, of course, everything in here is not meant to be legal, professional accounting or investment advice. You should always check with a qualified professional before taking action. So this session will explain some of the things you need to know that you are a property investor on a property journey. Property investing is easy, safe, affordable, exciting and necessary. And that is the subject of some of my other videos. But you need to have a lot of information behind you to make sure that you do have that safe, easy ride. We also want to be here with you throughout the entire journey, providing you with opportunities, assisting you with the process, and providing you with all of the education you need. So property is as safe as houses. Whilst property does go up and down from time to time, the long-term average of property is doubling every 7 to 10 years, an average return of 10%, which is more than the share market with far less volatility. Some people say, well, what if we have a recession? What about the GFC? House prices is the red line, just continuing to rise even through recessions. The grey lines are the recessions we've had. As you can see, some of the recessions, the property continues to rise quite substantially. Some recession, it flattens out, as it did in the GFC. However, recessions themselves do not affect the long-term trend. So what are the opportunities? In Australia, we have a huge undersupply of housing. Record population growth forecasts, continuing rising rents, very low vacancy rates. Most people with investment properties will only find them vacant maybe once a year for a week or so. We also have the lowest interest rates in 45 years. What that means is low barriers to entry. Almost anyone can afford to buy an investment property. So property is affordable. Do you think your future is worth $2 a day? Less than a cup of coffee or a rental property. So what action will you take? You may have already seen this slide, but I will cover it off again quickly, because whether you end up part of the struggling majority or the wealthy minority depends on what you do or don't do right now. Unfortunately, 76% of Australians are retiring on less than $20,000 per annum. Only 21% are retiring on $21,000 to $50,000 per annum. And a very few, 3%, are on more than $50,000. Just like to cast your mind to whether you think you could live on $20,000 per annum. It's basically the poverty line. Even 21 to 50 is only a moderate lifestyle, maybe a holiday a year, maybe out to dinner once a week, but it's certainly nothing flash. Most people I know expect to retire on 50,000 plus, but the reality is that is not happening. So, who are the residential property investors in Australia? They're actually only 13% of taxpayers. They account for 30% of the mortgages. The interesting part, though, is 60% of the investors, property investors, earn less than $50,000. So those people that think, oh, I couldn't do it, I'm not rich enough, it's actually the other way around. This is how you become rich. If you're even earning less than $50,000, more often than not, I can show you how you can afford an investment property. 85% of taxpayers of the investors earn less than $80,000. So once again, that's still a small income. It might be husband and wife earning $80,000 combined and investing in property. So that's just it in the in a picture format. Okay, so if you've bought one property or about to buy a property, congratulations, you're on your way to financial freedom. But unfortunately, one property will not be enough. But don't panic, we can show you how to duplicate, how to turn equity in one property into more, and how to buy enough to replace your current income. And that's the subject of today's video. What we're going to talk about is the power of equity and leverage. The three biggest hurdles property investors must overcome in order to buy their first, second, or 10th investment property. First one is, how do I get started? Second one is, how do I borrow? And third one is, how do I manage cash flow? So getting started is often the first step, the first hardest step that a lot of people don't do. A lot of people just get stuck on that one. You've got to get over that one first. How do you borrow? How's the best to organise the borrowing? And then, if you're having cash flow issues, how do you manage that cash flow? So how do you get started? Challenge number 1. You need a minimum deposit, normally 5%. So on a $400,000 home, that's only $20,000. There's also fees and charges. I always say to allow another 5%. So total deposit and fees, $40,000. So where does that come from if you don't have it? And let's face it, not everyone listening to this video is going to have a lazy $40,000 sitting in a bank account. So it can come from savings, or it can come from leverage. And more often than not, it comes from leverage. This is simply the power of leverage. If you had $30,000 invested in a bank account at 5%, yeah, you'll make $1,500 in capital gain, or otherwise known as interest. You'll be taxed on that. So depending on your tax bracket, you could lose half of it. You can take that same $30,000 and invest it on a $300,000 house. Let's just say that that house only grows at 5%. As we spoke about earlier, probably doubles every 7 to 10 years. So it's more like 10%, but just so we can compare apples with apples, let's stay at 5%. That's now a $15,000 capital gain, so 100 times more than you'd make just having it in the bank. And that's the power of leverage, which is using other people's money. In this case, you've borrowed from the bank. But what's that got to do with property? Leverage in terms of property is the use of current assets to build future assets, releasing equity, or otherwise known as equity unlock. So let's look at an example. Unlocking equity to achieve leverage. This is a common situation, I find. Current property you own worth about $550 and you owe only $230,000 on that. So what you're worth, this is called your personal balance sheet, and I can't say it strongly enough. Everybody should have an idea of their assets and liabilities, what they're worth. So what you're worth is not what you own. It's what you own less what you owe. In this case, $320,000. I never cease to be amazed by the people out there living in $1 million properties, driving very, very expensive cars, living the high lifestyle. But when you actually add up what they own less what they owe, some of them are bankrupt and own nothing or less than nothing. So let's look at equity unlock. So in this case, nothing that much changes. We just do what we call set up a line of credit, an undrawn line of credit. They've got available funds of $210,000. Nothing's changed. They still own $550,000 worth of property. They still owe $230,000. Nothing's actually changed. Net worth has not changed, but they've got available funds ready for future investing at $210,000. So they then use some of that undrawn line of credit to purchase a $400,000 property. As we said earlier, you need 5% for deposit and fees, and 5% for deposit and 5% for fees, a total of $40,000. That comes from the line of credit. In this case, you've still got $170,000 sitting in the line of credit, and you've bought yourself another property. So, personal balance sheet, what's changed? They've now got two properties. $550,000 plus $400,000 equals $950,000. What they owe, they've still got their original loan. They've still got available funds of $170,000 that they haven't used. And they've got investment loan and the amount $40,000 they've drawn. So what they're worth now still is what you own less what you owe. They're worth $300,000 now. If we go back, in the last scenario, the client was worth $320,000. Now they've withdrawn the equity and bought another property, they're worth $300,000. They've actually gone backwards by $20,000, and that's in fees, an unavoidable part of buying property. But you're buying it for the long-term capital growth, and that $20,000 in fees should easily be made up within the first 6 to 12 months of the ownership of the property. So build the portfolio. What's next? So in this scenario, rather than buying one property, this couple has bought two properties at $400,000 each, using deposit and fees of $40,000. They've still got $130,000 left in their line of credit. Personal balance sheet in this case, they now own $1.35 million worth of property. They've got a few loans here. They've still got $130,000 in their available funds in their line of credit, 2 investment loans, and they've drawn down out of their line of credit for deposit and fees. What is this couple worth now? Once again, they've gone down by $20,000, another $20,000, because they've gone down $40,000 in fees now. Once again, we're doing it for capital growth. But now this couple has unlocked the equity in their existing property and now has 3 properties growing in value for them. So what if you've got no equity or savings? That can be a big hurdle. It doesn't have to stop you forever. Firstly, you need to change your mindset. You may have no equity or savings now, but that doesn't mean you won't have in the future. You need to set yourself a plan. Decide you will and you can buy a property. And as I've shown above, you need to get one to get you started, and then the capital growth can get you the next properties. So if you have no equity or savings to get started, you need to budget. Sorry to say that, it's quite simple. It's something that a lot of people do struggle to do, but you need to cut excess costs. Start a savings plan, or if you have debt, a debt reduction plan. You can also borrow from family and friends. It's a very common strategy that some young people use to get started. Use equity or guarantees from family and friends. Even if your family can't lend you the money, they can use their equity or their guarantees to get you a loan. Buy a lower value property. Just get started. There are properties for $200,000, so you'd only need a $20,000 deposit. You can also use first homeowners and stamp duty exemptions for the first home. So in some cases that deposit can be wiped down to quite a minimal amount. So challenge number 2, how do you borrow? Take advice from an experienced mortgage broker who understands property investing. Not all mortgage brokers do. A lot of mortgage brokers simply focus on mum and dad home loans, buying their first home or their second home. You need to see a broker who understands property investing. Generally, we'll recommend you go to a maximum 95% LVR. There are tax benefits for doing that. You get to maximise negative gearing. You also get to maximise good debt. You want to borrow as much as possible for the properties and focus your other funds on paying down any loans you do have for your own property. Pay off the owner-occupied as quickly as possible. We also recommend interest-only loans for investment properties. Some people can feel uncomfortable with that. They have been brought up with the old adage of pay down debt. But if it's an investment property, no, we don't want you to pay down the debt. We actually want you to be saving your funds for the next property. So don't pay off the loans for investment properties. Borrow as much as you can in the first place, before the banks start to think you're overgeared. It's actually a lot easier to get a 95% loan in the first place. It'd be interesting to know that when you refinance a property, you can only go to 90%. But if you borrow 95% in the first place, you've borrowed as much as you can. Because banks actually assess you harder the more you borrow. A lot of people have the misconception that if they stay with one major bank and have all of their loans and all of their properties with one bank, the bank will look favourably upon them. It actually won't. Banks, the more you borrow off the one bank, the more you're seen as a risk for them, and the harder that they assess you for your next loan. So therefore we recommend you use a number of different banks so that no one bank has control of your portfolio. And don't, whatever you do, let the banks cross-collateralise your loan. I won't explain that in too much detail, but it's where the banks take each property as cross-collateral security for every loan. We strongly recommend you don't do that, and make sure, once again, use a mortgage broker who specialises in investment property, because they'll know exactly what that means and why not to do it, and make sure the banks don't. Because I have seen banks, the client has asked not to cross-collateralise, the banks will still tick the right boxes and make it happen anyway. So seek professional taxation advice also to maximise tax deductibility. Okay, so challenge number 3, how do you manage cash flow? Well, how many properties do you think you would need to replace your current income? Let's say you managed to accumulate $1 million worth of property, which the earlier couple did by simply buying 2 extra properties. Let's just look at the capital growth over a 10-year period. Properties doubling in value every 7 to 10 years. Properties going up by 10% each year. But it's actually 10% capital growth on growth. So it just doesn't go up by 100,000 a year, it continues to rise. So you haven't paid off any loan as we've instructed, you've kept the loan at the 1 million plus fees. In the beginning, this property portfolio was cash flow negative by $150. Maybe you couldn't afford the $150 a week shortfall in the beginning, and that's why you would buy one property and then buy another as soon as you're able to. Because what happens is that over time, rents go up, whereas interest payable on the loan, given rates stay the same, it stays the same. So this property has now become positive cash flow investment property by $750 a week. Now maybe $750 a week is not enough to replace your income, but the capital gain on that property is now in the vicinity of over $200,000 per year. So more on cash flow. You've been paying interest on that loan, so you still owe $1 million, but you've got $1.5 million in equity. You made a $235,000 capital gain in just year 10 alone. You've got positive cash flow of $250 per property, or $750 per week, so positive cash flow of $39,000 per annum. So the income for the whole year is $274,000. So have we replaced your current annual income with only 3 properties? Yes, the $230,000 capital gain is not cash flow, but it's still income, and you could still assess it by selling 1 or more of the properties. The trick is then, how do we manage cash flow in the early years? So the annual costs on a property are things such as interest, water and land rates, insurances, property management fees, lease fees, pest control, general maintenance. So the example of this property is total cost of $21,000. But what are the benefits you get? Rental income, obviously, depreciation allowances, tax rebates. Total benefits in this case are $21,158. So the cash flow is only $730 per annum, or $2 a day. Pretty good. So who actually pays for your property? The tenant pays for the most of it, 80%. The taxman gives you a break back of 18%. You only pay 2% for holding that property. By year 10, the tenant's paying almost all of it because rents have gone up. Taxman is giving you a bit less of a refund because it's more positive cash flow. You're not paying anything for your property. Who thinks that's pretty good? I certainly do. So principal and interest versus interest only, just to make it clearer. Okay, so if you have a loan of $380,000 at 6.3% over 30 years, principal and interest payment is $2,352. Interest only $1,995. So that's why we recommend interest only, because it's freeing up an extra $300 per month for you. $357 per month for you. So tips for managing cash flow. If you're still not convinced that you can afford $2 a day, let's have a look at other tips. Buy properties with a good rent yield. But note, this is not the primary focus capital growth is. Do not buy for rent yield alone. Buy properties in an area with low vacancy rates. Buy properties tenants will want to rent. Better still, buy properties with a leaseback guarantee. Some companies actually offer to lease it back for you. Although please talk to me about defence housing before you go down that option. You can buy brand new properties. They're a lot easier to rent. They've got lower maintenance costs, higher depreciation benefits, which equals higher tax benefits, which equals higher cash flow. So there's a lot of different ways of looking at cash flow. And be sure to seek professional advice to work out the cash flow on your property. So maximising cash flow means you can grow your portfolio faster by buying more properties. You can use what we call pay-as-you-go variation, so that your tax on your property reduces every month, increasing your cash flow. You also need to protect yourself. Buying properties with leaseback guarantees is one example, as long as it's in a good capital growth area and preferably not defence housing. Take out adequate landlord's insurance. Have income protection and life insurance. These are all very important things. You don't want to work so hard to build a property portfolio just to lose it because of an unfortunate accident or illness. So what's your strategy? The simplest strategies are often the best. One simple strategy is own your own home, and 3, investment properties. You'll be able to retire on a very standard good income. Or if you want more than that, additional lifestyle, world trips, etc., consider buying even more properties. So what is your investment journey? If you haven't heard this before, it's very important. I so strongly suggest you set up your structure before taking any further steps. You need to set up the structure, decide where you're going to buy, who you're going to buy through, what you're going to use in terms of company, trust, super funds, so many different things to think about. Prepare the plan, apply for finance, and do all of this before you even find the right property. So research your options, get advice, get it right before you begin, because those who fail to plan to fail. So luck is what happens when preparation meets opportunity. I've shown you here how you can retire in comfort by owning a minimum of 3 investment properties. So good luck. Know where you're going, because there's no hope of success for the person who doesn't have a central purpose or a definite goal. A property portfolio review, if you haven't already had one, is definitely worth getting done. We look at how many properties you can buy, how much you can borrow, how much will this cost you per week, how you should structure the purchase for tax purposes. It's only $385, which also includes an hour consultation and discussion about your plans and answering any questions. If you're interested, email me, catherine@wfscanberra.com.au. Also, if you haven't already, download our free report, How to Build a Property Portfolio the Right Way. The free report reveals the 7 elements to building a successful property portfolio, and it can be found at our website, wfscanberra.com.au. There's other videos in this series which you also should be watching. Property versus shares, why property, property investment strategies, land tax and properties, finance strategies, tax and rental properties, tax and property development, ownership structures, positive or negative gearing, and how to build a portfolio with passive cash flow. So if you haven't already, please view some of those other videos. So where to from here? If you're not already on our wealth coaching packages, you should have a look at wfscanberra.com.au/wealth coaching. Contact myself for further information. Thank you for listening today, and I just have a saying to leave you with. Life is a challenge, face it, meet it. Life is love, share it. Life is a dream, realize it. And life is a game, so play it. Thank you.